AI-driven earnings are still propelling equities higher, just as renewed rate hike talk and fragile energy supplies reopen big macro questions for allocators. This is vTalkInsight, Allocator's Lens Daily for June 1st, 2026. Let's look across equities, rates, credit, currencies, and commodities to see how the opportunity set is evolving late in the cycle. In equities, the core story remains an AI-fueled earnings boom running into late-cycle risks. The S&P 500 is on track for a ninth straight weekly gain, with May delivering solid advances for both the index and the Nasdaq, as enthusiasm around AI infrastructure and semiconductor names dominates performance. Commentators stress that this phase looks very different from the late 1990s. Index gains are seen as much more tightly linked to earnings, with S&P 500 profit growth projected around 20% this year and double-digit growth again next year, allowing higher index targets without relying purely on valuation multiple expansion. Company results back up that narrative. Dell, for example, has delivered exceptional AI server numbers, with revenue growth far ahead of expectations and a sizable backlog that has driven strong positive earnings revisions and a sharp re-rating in its shares, lifting peers across servers, storage, and memory. The AI theme is also broadening beyond U.S. megacaps. Asian equities and markets like Taiwan and South Korea are rallying on chip demand and domestic pension support, while small caps tied to AI infrastructure, semi-cap equipment, and even military modernization are seeing robust growth and contributing to Russell 2000 performance. Many see significant valuation gaps here. Small and mid-caps are described as materially undervalued relative to mega-cap tech, with a combined value of broad small-cap indices still below that of single large platforms, which is encouraging active stock picking even as passive and exchange-traded fund flows concentrate exposure in a shrinking group of dominant leaders. Under the surface, though, the equity picture is less comfortable. On some days, only about 200 S&P constituents rise, while roughly 300 fall, highlighting weak breadth, rising concentration risk, and the possibility that any disappointment from a handful of key AI or tech names could trigger a sharper index-level correction. Forthcoming mega initial public offerings reinforce that concern. Space-related and AI-focused listings are expected at valuations near or above $1 trillion, often with founder-controlled share structures that raise governance questions and add significant new equity supply for the market to digest. Macro fundamentals also send mixed signals. Real household incomes have fallen in most of the last several months. Credit card delinquencies are rising toward $1.4 trillion imbalances, and some retail brands are reporting weak sales, even as successful sub-brands within the same groups post strong growth, underscoring a more selective consumer. Market structure has changed as well. The equity cycle has moved from momentum-led to earnings-driven, which typically means slower index gains and choppier trading. AI-related capital expenditure is now seen as the main engine of S&P earnings growth. So any slowdown in hyperscaler spending or renewed policy tightening could challenge the durability of the current rally. Despite those vulnerabilities, volatility remains contained. Equity volatility gauges sit in the mid-teens, and hedging a 5 to 6% S&P drawdown through index puts is reportedly inexpensive, allowing allocators to consider protecting recent gains at relatively low cost as they weigh the risk of rotation away from U.S. tech toward more cyclical or oil-sensitive sectors if Middle East tensions ease further. Moving to rates, the dominant theme is a renewed higher-for-longer bias. Market expectations for U.S. cuts have largely unwound, and several Federal Reserve officials now emphasize that the balance of risks has swung back toward inflation, keeping the option of a rate hike open if disinflation stalls. There's a growing view that the neutral interest rate may have risen. Commentary suggests it could sit above 4%, given how resilient activity has been at today's policy settings, reinforcing the idea that policy is not as restrictive as previous models implied. At the same time, the bar for actually tightening again looks high. Some Fed voices highlight that price pressures outside a few sectors remain relatively subdued, arguing for a prolonged pause even as AI-driven capital spending and strong labor demand add incremental inflation risk, and lower oil prices this month provide temporary relief. Europe sits further along the hawkish spectrum. Markets assign a high probability to a June European Central Bank hike and expect several moves by year-end, while recent minutes flag material upside risks to inflation. Yet European fixed income is still viewed as attractive, with relatively steep curves and the possibility that only one or two additional hikes ultimately materialize. For allocators, this backdrop keeps term premia supported and weakens the traditional stock-bond hedge. Volatility in longer-dated yields continues to spill over into real estate, where transaction activity rises and falls with every move in Treasury yields, underscoring the need to track each inflation release and central bank communication closely. Credit markets continue to signal confidence, but with limited room for error. U.S. investment-grade spreads sit near their tightest levels in more than 20 years, reflecting strong corporate balance sheets and heavy demand from pensions, insurers, and other long-duration buyers. All-in yields, however, remain meaningfully higher than in the previous cycle. That combination of tight spreads and attractive coupons keeps flows strong into both public bonds and private credit. While around $160 billion of investment-grade issuance has already been absorbed, much of it linked to large technology and AI infrastructure projects. Several observers describe a perceived shortage of bonds. Demographic trends and regulatory needs are driving structural demand for fixed income. So even substantial new issuance has not generated visible capital constraints, and spreads have barely moved as markets fund the AI capex boom. Beneath the surface, though, pockets of stress are building. U.S. credit card delinquencies are rising. Some private credit exposures in software and retail show elevated non-accrual rates. And there is concern that persistently tight spreads and high asset prices leave little cushion if growth slows or policy becomes more restrictive. In foreign exchange, the recent bout of dollar strength is increasingly viewed as fragile. Strategists argue that if geopolitical tensions in the Middle East continue to ease and central banks like the European Central Bank and Bank of England keep tightening while the Fed stays on hold, policy divergence could begin to work against the dollar. Seasonal patterns add to that case. The dollar has historically weakened in June and July against major peers, and a repeat of that tendency would provide a tailwind to non-dollar assets, particularly where local central banks are still in hiking mode. That relatively benign view does not extend to all currencies. Aggressive hikes in countries such as Sri Lanka, Indonesia, and Pakistan have failed to stabilize their exchange rates, which remain under pressure from economic distress and high oil import bills, highlighting that policy tightening alone cannot offset weak fundamentals. The Japanese yen is another focal point. With inflation still elevated, domestic yields drifting higher, and the currency weakening toward 160 per dollar, the Bank of Japan faces mounting questions about its very accommodative stance and the risk of a perceived policy mistake. Asian equity moves underscore these crosscurrents. Markets like Taiwan and South Korea are hitting records on AI demand and domestic pension support. Yet the Korean won is weakening as foreign investors rotate out, reminding allocators that strong equity performance does not automatically translate into currency strength. Commodities, especially oil, sit at the heart of today's macro tension. Crude prices are experiencing their steepest monthly drop since 2020, with U.S. benchmarks down about 10% this week, as progress toward a 60-day truce between the U.S. and Iran and talk of reopening key shipping lanes compress the geopolitical risk premium. That price relief is feeding through to other assets. Lower oil has eased near-term inflation anxiety, supported firmer equity levels, and contributed to slightly lower Treasury yields, while European cyclicals like airlines and automakers have outperformed as energy costs retreat. Beneath the calmer surface, though, supply looks precarious. Global oil inventories are steadily declining, with sizable drawdowns expected into the summer. Physical shortages have already appeared in parts of Asia, prompting rationing, while U.S. gasoline and diesel stocks are near their lowest since the early 2000s, even as refineries run close to capacity and exports to Europe remain strong. Natural gas markets face their own constraints. Qatar's largest liquefied natural gas export facility has lost a significant share of capacity due to war damage, with repairs expected to take 3 to 5 years. And even with a ceasefire and partial reopening of shipping lanes, flows are unlikely to return quickly to pre-conflict levels. Industry voices warn that this sets up meaningful tail risk. If demand proves resilient and geopolitical disruptions flare again, today's lower oil prices could give way to sharp spikes, with some scenarios pointing to levels far above current spot benchmarks. That keeps energy central to the inflation and rate debate, even as equity markets currently treat cheaper crude as a straightforward positive. Stepping back, the cross-asset picture is one of strong risk appetite, resting on increasingly narrow foundations. Equities lean heavily on AI-driven earnings and small-cap catch-up. Credit offers attractive carry, but only thin spread protection. And rates markets are converging on a higher-for-longer world as inflation and energy dynamics keep central banks on edge. Currencies mirror this, with a potentially softer dollar alongside fragile importers and a pivotal yen. While oil's recent pullback masks a still tight physical backdrop that could reignite inflation at short notice. For allocators, the key signals now lie in each inflation print, central bank tone, and any surprise around AI, capital, spending, or Middle East geopolitics that could challenge today's benign volatility regime. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.